Next, I'd like to invite two experts from CAFE. First is Joseph Wong, Senior Executive Vice President of CAFE Life Insurance, who has extensive and profound experience in fundamental research and overseas investment. The second expert is Chi Chao Lin, Chief Economist of CAFE United Bank, who has deep insights in macroeconomics, geopolitics, dynamics, and capital markets. He is often providing consulting services to government agencies, think tanks, and private firms.
Welcome my three panelists again. So good to see you here again in Taiwan. 谢谢你们一起加入今天的大师会谈，算是第。
Thank you for joining this forum.
Although we touched a little bit about this one just now, can you share with us, Rich, what's your most memorable experiences and moments? In fact, we talked about this. You said he's a man who loves to keep his options in pocket.
Well, I was there for 4 very eventful 4 years. I'll cite 2. I'm very proud of the way that the Fed navigated 2019 in the sense that we had raised interest rates to 2.5%. We then realized that we didn't need to go any higher because, if anything, inflation was falling. We also didn't listen to our critics and the modelers who said, you have to keep raising rates because too many people are working. The unemployment rate's falling. And we let that happen. And so millions of people were employed and got a raise. And the economy was in a very good place before March of 2020. So I'm very proud of being part of that group that did that.
Is there a memorable dialogue that you can recall? Just want to know a little bit more about your experiences there.
Well, the entire period in March of 2020 was memorable. It was frightening, and we had to make a lot of consequential decisions in about a 10-day period to prevent the U.S. financial system from collapsing. We took a lot of decisions during that time, I think, that have held up quite well. So, yes, indeed, it was memorable. I wasn't sure how it would turn out then, but I'd cite that, yes.
I see. So in Taiwan, we watched closely about the U.S. presidential election. So we're wondering if Fed may hold off any action given its election year. Can you give us some historical perspective on this?
So the Fed does like to stay out of the political spotlight. The Fed jealously guards its independence. And so one might infer from that that the Fed likes to essentially stay away from making decisions in election years. That is, the best way to stay out of the headlines is don't raise or lower rates in presidential election years. But in fact, the record will show that at least in the last 40 years, the Fed has typically been hiking or lowering rates in election years, not because it wants to influence the election, but simply because the data has been calling for that. So the Powell Fed's going to do what it thinks it needs to do to achieve its goals. And as I said in the earlier segment, we believe that means cutting rates beginning this fall.
And data dependent, right? So continue the previous discussion. We want to know more about the neutral rate here. Do you see neutral rate will ultimately set higher in this cycle of year?
Lots of discussion. So what is the neutral interest rate? It's a concept that is focused on in central banking. And quite simply, the neutral interest rate is the interest rate a central bank sets when everything is going great. So in the case of the Fed, what interest rate should the Fed set if inflation is exactly 2 and everybody who wants a job has a job? And the Fed estimates that that number is around 3%. Now, rates are a lot higher than that now because until recently, inflation's been too darn high. But the neutral rate is the anchor for rates when everything is going as well as you want it to. Now, we can't measure neutral rates directly. We have to infer them. There's a lot of disagreement among both central bankers and academics about what they are. But at PIMCO, our view continues to be what we've called our new neutral thesis now, which we've been discussing for 10 years, which is we think neutral rates in the U.S. are around 3% right now.
I see. Thank you, Rich. Now I'd love to direct to Joseph. 国泰人寿的资深
So Yichong, our senior vice president from Cathay Life, and he has been managing a big investment position. So what do you think of this same question? I think regarding the Fed's interest cuts, if we look at the charts, it suggests that there will be a quarter of a percentage point this year and 4/4 of a percentage next year, and then they will go to a neutral level. But personally, I'm leaning towards to 1/4% in September, and subsequently, if there are more cuts, if there will be more cuts, I think they will be more cautious about that. And we had the latest CPI from yesterday, and over the past weeks, we saw some drops in the markets because they are already reflecting the potential Fed rate cuts. So personally, I think at this moment, Fed will be more prudent and cautious because they have to manage the inflation. And this also has to do with their credibility. So I think in terms of rate cuts, they will be more cautious. And my personal forecast is at September, and I think there will be only once this year. I think we're close to that rate cuts point. And Qichong, we also talked about the same issue a while ago, and Joseph said that he expects 1/4% drop in September. And of course, there will be further room for cuts. But let's say if Fed's policy is higher for longer, what would the implications would be? Rich talked about the neutral rates. I think it's neutral rates is not a statistical number. It's not based on trading. It's estimated by a model. And Fed's model may have different versions of neutral rates. Rich may have his version, and other people may have different versions. And I think that's very difficult, particularly because of the pandemic previously. The model is now facing challenges. So what we see is that the neutral rates in economics is called R star. It's like the North Star in the sky. So there's something that we can anchor against, but you are not very clear about this thing. And next year could be Powell's last year. So I think the path forward, I personally think the uncertainty would be higher. Although I also believe that there may be one cut in September, one in September, one in December, but I cannot be confident of when the first cut will be. But I think the terminal rate may be slightly higher than what people expect today. That's my view about interest rates. And personally, I think in terms of higher for longer policy, I think we are seeing the implications already. As you can see, the consumer credit default rate in the US is already higher than the pre-pandemic levels. And if you look at credit card, it's 3.3%. This is already higher than the pre-pandemic level, which means higher for longer. You probably don't feel much about this policy because of the stock hikes, but in the medium term, you need to do refinancing, and it's challenges for people with high risks. And when Musk talks about his Tesla, his car loan rates is 7.88% already. So for consumer goods, especially durable goods, higher for longer are already having implications on people. Even if we do see rate cuts going forward, the terminal rates, if it's higher than what we expect, this will impact the recovery of the economy. So given this, what's the implications for individual investors? Big question. If it's fixed income, I think the interest rate is still at a relatively high level compared to the past 10 years. For example, on average in the past 10 years, it's 2.5%. Now it's 4.2 roughly. So if your mindset is that you want to pursue cash flow, for example, 40–50% interest income for 10 years, it's a good timing for you. But you cannot say that because there may be a interest cuts in September or December, there's a big opportunity for you. I think that's too big a dream, because we are already factoring in the potential interest rates in September or December. So in the future, the room may be limited. Okay, we'll come back to this later.
One disruptor mentioned this U.S. debt sustainability. We want to know that for a very long time, U.S. has operated with large budget deficit. And it doesn't appear that it will change anytime soon. So do you think how much the risk does it pose right now?
Well, as I mentioned a moment ago, I think the U.S., without questions, on an unsustainable fiscal path. The big question is, at what point will Washington do anything about that? And it could be for a while. The dollar continues to be the global reserve currency. Treasury is the global reserve asset. And so it was once said, I think, by Charles de Gaulle, that the U.S. enjoys an exorbitant privilege. And that was 50 years ago. And if anything, it's even more exorbitant now. However, we do argue in our yielded advantage essay that we do think that there are already consequences of the big stock of debt and the big deficits in the Treasury market. And in particular, we see evidence of a positive term premium returning, which simply means that bond investors can expect to earn over the 10-year holding period, say, of a 10-year Treasury, a positive premium for taking on that interest rate risk. And that was essentially very low or even zero during much of the prior decade. And so we do think that, that the world is going to be changing in that way.
I see. 齐超接下来就是我们借着这个美。
So Qichao, again on the U.S. debt issue. So fiscal deficit is not news. And earlier we talked about the U.S. election. We don't know who will be competing with whom, and we don't know who will win. So do you think there's a big change in the potential deficit path forward? I think it will increase because it's always there and it continues to increase. The last time I checked yesterday, I think it's already exceeding the deficit limit. So January 2025, they will probably talk about lifting the limit once again, because every time when they hit the limit, they increase the limit again. But I think for investors, we will start wondering, as the deficits continue to pile up, does this mean that there will be more supplies of treasuries? And would that drive the interest rates higher? I think, yes, on the supply side, that's true. But don't forget about the demand side. What I mean by that is that if you look at Taiwan in the first 5 months this year, there's more than 500 billion purchase in EDF. So Bernanke talked about global savings guards. So global excess savings is driving down the interest rate of U.S. treasuries. So when the pension funds, your sovereign funds, when you have more foreign reserves, you need to have place to put these money. We only have one globe, one planet Earth. This money needs to go somewhere. But you need to make sure that you put this money in a safer place, and it would be the U.S. treasuries. Although it may not be the best, but it's at least the second best. So I think the U.S. fiscal deficit will continue to go up. And for example, this year, if you look at the interest payments, it's already exceeded their defense payment this year. So we already see this trend, and you cannot reverse this trend single-handedly. And if the same person, if that person got reelected, it would be even higher.
So what do you see about this rise? So on the supply side, because of increasing debt, then for the Treasury, in order to get more financing, they can only issue more in the next few years. But I think in the market, there is a strong force, which is the demand side. Because with the strong demand, essentially, one example I bring is, for example, Cathay Life Insurance. If they get 1 trillion of insurance and they put it in the chairman's drawers, after a year, he'll be concerned because he will lose money. So he is forced to make investments. If the money is not invested in somewhere else, then it will essentially be a loss. So the same thing happened in Japan as well. Individuals or insurance companies, because the spread is even larger than Taiwan, so they have an incentive to invest in the US market. So I think that the bond supply would go up, but at the same time, there is a strong demand, and originally, it would bring down the interest, which should have gone up.
Last question in this panel discussion is a follow-up question about currently U.S. yield curve is now inverted. So very simple question, should investors expect this to continue to persist?
Yeah, so what is an inverted yield curve? It simply means that the yield on a 3-month T-bill is above the yield on a 10-year Treasury. And inverted yield curves are unusual historically. And at least in the U.S. context, inverted yield curves tend to be indicators of a future recession. They don't have an infallible track record, but in many cases, when you get an inverted curve, you get a recession. This time may be the exception. What I will say, however, is inverted yield curves are not the new normal. We think the U.S. Treasury curve will re-steepen. The question is, how does it re-steepen? And we think that primarily it will happen as the Fed is cutting rates. And so low bond yields at the front end of the curve fall, the curve gets steeper, and that actually over time generates a positive excess return for someone holding the longer maturity bond. And so that re-steepening is going to be very dependent on when the Fed starts cutting and how rapidly they cut. But we think eventually it will happen. And moreover, as of at least yesterday, before I went to the airport, it was not at all priced into interest rate futures, which see the curve is basically flat for the next 3 years.
I see. Thank you. 那总结接下来我们马上
So now, before we move on to the conclusion, maybe we can ask Joseph one last question. So could you please talk a little bit about, in this overall environment, with everything we know right now, are there new asset allocation concepts that you can bring to the audience? I will also ask the same question to Chi-Chao as well. I think with the current environment, with rising complexities, the capital markets changes have been persistent for 2 years, and the equity market has gone up in both Taiwan and the US. Now, for the risky assets like the equity market, it is about time to balance the risks. But based on historical performance, before any interest rates cuts, we actually see that this duration can continue a bit, the rise in equity. But right now, investors need to be more vigilant about risk factors. So my reference on asset allocation to the audience here today, I actually very much agree with what Rich from PIMCO mentioned. Right now is a time where core fixed income could be a key portfolio factor. I think that high quality fixed income products, for example, higher grade corporate bonds or agency RMBS or real estate backed obligations. These are all backed by U.S. agencies with a higher credit rating with a yield of around 6%. So if you want to look at higher quality corporate bonds or agency MBS, then you can get an average of 6% of yield. So I would suggest at this moment in time, that being the key allocation for your assets. And I think that the share of that portfolio can go up to 50 to 60%. Now, this excludes your cash position because everyone has different decisions and risk appetites. But I would suggest that your holding for financial assets, you could allocate most of it to high-quality fixed income products. On the other hand, I think you can try to find a growth equity, because in the past 2 years, I've been telling my team that in a high inflation environment, my lesson learned or my takeaway would be high growth equity, high growth stocks is still a relatively stronger protection for you. It's very straightforward. If you invest in a company that can deliver 20 to 30% growth, then on a simple reference, you wouldn't really care if inflation is 5 or 8% because their growth is high enough to offset the impact from inflation. So your real returns are still cushioned, but I think it needs to be fairly valued. So it has to have a fair valuation because in the past few years, we see a lot of these growth equities skyrocketing in price. So in general, I think that their valuation is still quite high. But anyways, the market is still moving, fluctuating, and in the past few days, we saw market adjustments too. So when the timing is right, we can really consider these growth equity products. As for the last 20%, I would suggest illiquid products, but have a longer term strong yield. For example, PE funds. Now, of course, there's many different PE fund products, and we have a specific session in the afternoon to dive into this topic. I think that PE funds could also play a very key role in your asset allocation. There are also other minor categories, for example, commodities. There are specific sectors that I think are optimistic about, for example, copper, gold. These have fundamental advantages. So this is a simple reference for your asset allocation.
想法。那启超呢？
Thank you for your suggestions. So Qichao, you also mentioned this is a big question. So why don't you help conclude today's panel by giving suggestions?
蛮完整的。
I think Yi Chung has said it very well. Just a quick comment. Actually, yesterday is an important day because the market cap of Taiwan and stocks divided by M2 is 1.35 multiple. What does that mean? It's the January-February number in 1990, which means it's really heated. So we need to increase our risk awareness. I think it's important. It's not that we look bad on the stock markets or that there's not the fundamentals are not there, but I think there's been a recent heating in the stock markets. So we really need to remember this because we have drive all these to a very high valuation. And for example, you see we start the markets and it dropped by 500 points. So the volatility will increase in the future. And this is something that we have to be aware of. And if there's a big drop, given that our fundamentals are recovering, like what Yi Chung said, we need good cash flow, good fixed income investments for us to protect ourselves. Okay, thank you, Qichao. I think this is the second time that I've been sitting with the three of you. And last time we had an interesting element, and I still remember it today. And that's to learn from your perspective in a simple way to show everyone in the room and everyone on the line. So we will not talk more, but please hold up the props. And we hope that this will help you remember a few, the key perspectives from our three masters today through these simple questions. So what we want to do is to do a quick rapid fire. So please use these cards to tell us your answer. 4 questions, quick questions.
Before, right? So first one, when the Fed first rate cuts? A, Q3 2024, B, Q4 2024, C, Q1 2025, and D, after Q1 2025. Ready? Go. Oh, 好咯，不多说。
Okay, everybody see the answer.
Question. Ready? What underappreciated risks keep you up at night? Justin asked about this. First, U.S. presidential election. B, central bank policy and sticky inflation. C, tech and AI disruption. And D, geopolitics. Rich, do you need a moment? Yeah. All right, ready? Go. Okay. B, central bank policy, sticky inflation. And D, geopolitics. All right. Oh, sorry, excuse me, my last question. Which asset class will you increase in your allocation to the next 6 months? A, alternatives, that means real estate, private equity, private credit, and hedge funds. B, cash. C, public equities. And D, public fixed income. Ready? Go. Thank you so much. Thank you so much, Rich, yourself, and Ch4. Thank you so much. 邀請我的来宾可以先。
So I would like to ask my guests to stand up and take a group photo.
So much for this wonderful panel discussion. Thank you.